Good morning, everyone. My name is Regis Martin. I am the chairman of the Alternative Investment Council, AIC. Thank you very much for attending this event. This is our third webinar in the AIC Sustainable Finance series dedicated to alternative investment. And before telling you more about today's agenda and speakers, I would like to give a brief overview of the Alternative Investment Council for the one not knowing us too well. The Alternative Investment Council, AIC, has been initiated in 2006 by its founding fund of hedge funds member who strongly believed at that time that Switzerland was missing a dedicated alternative investment association. In 2007, they joined forces with the Swiss Fund and Asset Management Association and became an expert committee. Back then, SFAMA wanted to acquire more knowledge and expertise in the alternative investment field, and the AIC needed more means to pursue their goals. Today, the AIC and their members are highly recognized discussions partners within the Asset Management Association Switzerland, with the Swiss regulator, the Ministry of Finance, and other Swiss authorities. The AIC consists of alternative investment representatives of the Asset Management Association, and its members are all on senior level and business oriented. Our main goal is to promote alternative investment in Switzerland through conferences, publication, panel discussions, events, and webinars. When we chose the topic for today, we wanted to echo the launch last October of the Swiss Stewardship Code and focus on what it could mean for alternative investments. Within alternative investments, you all know that asset owners may have a more direct access and control on their investments, and because stewardship is considered as one of the most effective sustainability approaches, we believe that it may be a perfect match to an important contribution to sustainability goals. But firstly, we need to set the scene properly. Clara Mello, who is System Stewardship Specialist at PRI, and Aurélia Fay, our Senior Sustainability Expert at AMAS, will give you a global and local overview of being a responsible investment steward. Then, Ula Ene, Lead Responsible Investments at Nest Pension Fund, will talk about the asset owner perspective on stewardship. Then, two alternative investment case studies will be brought to you by Joanna Castro, Head of Primaries and Climate Impact at Unigestion, and Hannah Edströms, Head of ESG Liquid Markets at LGT Capital Partners. Finally, Peter Sieg, a member of the AIC for many years, that I thank you today again, and who is co-chair of LGT Capital Partners Climate Actions Committee and lead the firm-wide net zero effort, will moderate a practitioner roundtable with some of our today's speakers. But before starting, I wanted to thank the Asset Management Association for their great support, namely Aurélia Fay, and of course, our speakers for their time today. So let's start, but before that, please note that we may have time for questions at the end of the webinar. So please be kind enough to ask them in written and in English directly in the webinar Q&A window. The button is at the center on the bottom menu. So once again, thank you very much for attending. Let's start. Clara and Aurélia, the floor is yours.
Thank you very much, Regis, and thank you to AMAS and AIC for their invitation to come and provide a brief overview of international and European stewardship practices. I'm a stewardship specialist at the PRI, but a caveat before I start is that I'm not an alternative investment specialist, so my focus here will also be to try and highlight wider developments and trends tying to implications and resources for alternative asset investors where possible. In order to set the scene for today, looking at regulation and guidance, we should take note of the uptake in stewardship codes. We've seen new stewardship codes over the past year or so. New Zealand introduced its stewardship code in September 2022. Spain published guidance in 2023. But obviously for 2023, the highlight is that in early October, AMAS and SSF published the Swiss Stewardship Code, and we're lucky to have an author and a contributing author of the code involved in our webinar today. Particularly encouraging is the uptake of two existing codes, a lot of progress. These codes have been updated in 2022, the Japanese Stewardship Code, which now has 329 signatories as of September, and the UK Stewardship Known, which is known for its high level of ambition, has seen its signatory numbers reach a new high in 2023 with over 270 signatories. Moving on to reporting and greenwashing, I will keep this brief as this could be a whole webinar in itself, but against the backdrop of anti-ESG sentiment on the one hand and growing regulatory scrutiny on the other, investors are more cautious around claims and communications related to their investment and stewardship activities and credentials. So one will remember, for example, the SFDR-related fund reclassifications earlier in the year. A note here is that to better support harmonization and reporting against clearly agreed terms, the Global Sustainable Investment Alliance and the CFA Institute, working with the PRI, have published harmonized definitions for responsible investment, including a common definition of stewardship, and this will be included in resources shared after the webinar. We know that investors are also under increasing pressure to account for ESG impacts of their investment decisions, and to do so they need quality data for companies, which means that the corporate reporting landscape is also changing with regulations such as the EU Deforestation Regulation or the EU Corporate Sustainability Due Diligence Directive. The broad endorsement of the ISSB standards has been good news this year, but investor data needs are also illustrated by initiatives such as the ESG Data Convergence Initiative, which focuses on performance-based ESG data from private companies. So this tells us a bit more about what forces are at work in the background, but in terms of regulation and guidance, but we can also look at how scrutiny of stewardship is changing. So a clear trend from us, and the next item in our list, thank you very much, is that we're seeing more focus on exactly what investors are doing when it comes to stewardship. And this scrutiny comes from asset owners as well. We're seeing more expectations with regards to alignment and accountability in areas such as voting and engagement records. And this is something where asset managers can expect to be challenged. In the UK, a group of asset owners have commissioned a review of how their long-term investments and the long-term interests have been served by their managers. This was particularly looking at proxy voting at major oil and gas companies, and the review has found that varying degrees of misalignment in voting behavior. Again, a link to this will be included in the resources. These findings of misalignments are being discussed with managers, and it is to be expected that this may inspire further scrutiny and have implications for selection, appointment, and monitoring practices. And these practices also extend, of course, beyond listed equity. What we see is that practices like tracking sustainability outcome of activities and embedding ESG consideration in contractual document is often overlooked in alternative assets, particularly when it comes to hedge funds. We also see it in passive fixed income. What we see is that asset owners investing in real estate and infrastructure monitor investment managers across a good range of responsible investment practices, but passive assets and hedge funds tend to have a bit less oversight. So this is an area where we expect to see progress. A note here that over the past 2 years, the PRI published several DDQs on these kind of issues, including for private debt, real estate, fixed income, hedge funds, investors, as well as venture capital and private equity, LPs and GPs. Another issue that's going to be more visible is going to be on the lack of resources for stewardship. This applies across all asset classes, and the need for more stewardship resources is also felt outside of listed equity. On the private equity side, of course, some GPs may have relatively concentrated portfolios with few companies, few industries, and they may be quite hands-on and have a more active approach to ownership. But in some cases, also efforts have a completely bespoke approach, which means it might lack scale. In alternative asset classes taken more broadly, there seems to be a perception that the need for increased resourcing is higher. Moving on to stewardship and escalation practices. In listed equities this year, we saw less majority proposals, but I think that rather than apathy, we should consider this also as a sign of growing investor attention towards specific issues and more challenging asks, which can garner less support. There's been also some wins achieved before the AGMs, and therefore the resolutions have been withdrawn in some cases. But as alternative asset managers may appreciate, being able to file a proposal is not a be-all and end-all. From an outcomes perspective, we have seen and published research on the fact that even majority proposals are not necessarily being implemented. That means there's a need for a push for board accountability, whatever the configuration of the company is, and whether investors have board seats or not. And there's a big push also for investor education. Here we can highlight the example of ESG for Boards, a Swiss initiative launched to ensure that there is expertise within Swiss boards. Something else to note very briefly is that litigation-related opportunities when it comes to escalation seem to be gaining attention. On the private equity side, GPs are increasingly using their powerful voice to drive change, and we see this being encouraged by LPs as well. We know that a few added questions from clients to their asset managers can go a long way. However, escalation remains a weak point, while private market investors and alternative asset investors are well placed to exercise stewardship based on scale and time horizon of their investment. The issue which seems to dominate is that escalation tools might feel like nuclear options. In terms of ESG issues that seem to dominate in private market conversations, they are quite similar to what we see in listed equity: climate change, diversity, equity and inclusion, cyber security, and general ESG management systems. A note that the PRI is working on stewardship and private market guidance. Stewardship in private markets. On that side, however, something to note is that there is much less pressure coming from the regulator than in listed markets, and therefore the pace of progress is a bit slower. Last but not least, when it comes to another highlight, I think in terms of trends, is the momentum around collaborative approaches. You may be aware that Climate Action 100+ entered its second phase, and it continues to involve bondholders alongside listed equity investors. In June, a new guidance was published to support bondholders in shaping the transition to net zero. So this is a good example of collaboration across different kinds of asset classes, which could perhaps yield to broader collaboration, including with alternative asset investors. There's also been big progress and announcements for biodiversity, including with the launch of collaborative initiatives such as Nature Action 100 and the PRI Spring Initiative. Human rights as well are big in terms of focus and advance. The PRI's initiatives for human rights was launched at PRI in person this year. But beyond just listed equity, we can name initiatives such as the PRI's ASCOR initiative, which stands for Assessing Sovereign Climate-Related Opportunities and Risk, and the Australia Sovereign Engagement on Climate Change. On the private equity side, the Initiative Climat International and the ESG data convergence shows that investors care about being able to push on the data side and obtain better disclosures for companies. It's noteworthy that a good number of investor initiatives seek to address sustainability issues, looking from a wider and systemic perspective. There is growing awareness of the impact of lobbying, and more initiatives seek to counter the effect of corporate lobbying on much needed policy progress. Finally, what we see is that leading investors, particularly through participation in initiatives, are now starting to think more about stewardship beyond issuers. This is an issue which we expect to see to keep gaining importance. System stewardship was a key topic at PRI in person, and results on the subject are starting to emerge with a new guide from ICGN entitled Systemic Stewardship and Public Policy Advocacy Toolkit, or the freshly published report by the Investment Integration Project called Recalibrating Feedback Loops. A takeaway for alternative asset investors here is that they can, while they may be used to collaborating with co-investors to a certain extent, they should certainly consider opportunities to engage and exchange resources with different types of investors as well as with regulators. Thank you very much.
Thank you very much, Clara. And for this overview on the international side. I'm happy to provide you with to share an update on the Swiss developments related to stewardship, and in particular to take the opportunity to introduce and present the Swiss Stewardship Code that was published in October this year by AMAS and SSF. So the code is very general and doesn't focus on any particular asset class, and it should be applied generally and interpreted having in mind the specificities of each asset class, and in the present case, obviously, of alternative investments. But first, a few elements of context. If we can move to the next slide, is here you have the link to the code for those who haven't got the chance to read it. And if we move now if we go through a few elements of context. So stewardship is an investment approach that have always been used in the financial sector and in the real economy. It's not specific to sustainability, but in recent years, voting and engagements have really gained importance as sustainability and the aspects related to contributing to a positive change in the economy, society, and the environment have taken more space. So among the different sustainability investment approach, stewardship is particularly effective to achieve impact. And indeed, unlike other sustainable investment approach, such as inclusion, for instance, when you do stewardship as an investment approach, you really aim to work with the investee company to guide them through the transformation that are needed to achieve these positive, sustainable results over the long term. And as we've seen, I mean, internationally, stewardship practices have been evolving very rapidly and are being adopted. And in a lot of cases, stewardship codes follow also similar codes of corporate governance in the real economy. In Switzerland, the truth is that the landscape is very diverse and complex, and engagement of voting is being done and taking place in different ways. Different financial institutions have developed their own approaches to stewardship, resulting in often a lack of standardized practices and reporting frameworks in the Swiss market. So as a result, investors, so asset managers, asset owners really have often faced difficulties in understanding and comparing basically their stewardship efforts. So that was really with this rationale in mind that AMAS and SSF developed and published the Swiss Stewardship Code. It was launched, as we mentioned, in October this year in the context of building bridges. And the goal of the code is basically twofold. First, it really aims at elaborating standards defining stewardship as a sustainable investment approach, which, as we mentioned, is very effective in achieving positive impact. And second, it really was the goal to provide a level playing field and lay down the foundations to foster comparability and transparency in this of stewardship best practices. And this need for transparency was also highlighted as a key area of action in the Swiss Federal Council strategy for 2025. So while being very much focused on Swiss investors' practices, the code really builds on the extensive local and international experience of AMAS and SSF members. The code was elaborated by a practitioner for practitioners with the expertise of members from AMAS and SSF, ranging from asset managers, asset owners, but also service providers. And the code really acknowledged the diversity of those actors that are necessary. That really works towards stewardship efforts, and that also vary in their business model, in their sizes, and basically that conduct stewardship in different ways. Global standards, so including the ICGN standards, UNPRI, as well as the UK stewardship codes were really international benchmarks when it comes to elaborate the code, and is mostly, and the Swiss stewardship code is mostly in line with those international standards as well. One point to mention, so the code is a set of recommendations. It's applicable on a voluntary basis. It doesn't form part of AMA self-regulation. And that also means that there is no signatory basis for the code at the moment. And what's next is that basically the code will be updated on a regular basis as stewardship market practices evolve. And we will now focus at AMAS on facilitating the implementation through different tools. And this webinar is also one way to make sure that there is a wide understanding of what is the stewardship code about. If we move to kind of the content very briefly of the code, to the next slide, we'll see how the code defines stewardship. So as I mentioned, stewardship, what's important in this definition that you see on the screen is that stewardship is an investment approach, first and foremost. So it builds on the different sustainable investment approach laid down in AMAS and SSF recommendation, but also in the AMAS self-regulation that came into force in September. So that's really part of the key approaches to conduct sustainability, to achieve sustainability goal. And stewardship can be conducted through two means. First, obviously, the active exercise of shareholding voting rights, so voting, and second, through the engagement in an active dialogue with the investee companies. Those are really the two critical means. And an important part of the definition is also foremost, the importance of the outcome that is sought through stewardship. The goal of stewardship is indeed to generate a value for finance, so financial returns, obviously, environment and society, as well as reaching a long-term sustainable outcome. So you really look at those two aspects, and that's really important to mention that it's a comprehensive set of factors that needs that are at play when we think about the definition of stewardship here in Switzerland. Now, looking at this definition, being a good steward is quite demanding, and a constructive collaboration and coordination between the different actors are key. And so if we move to the next slide, we see that stewardship involves different all the different stakeholders, from asset managers, asset owners, service providers, in order to work with the investing entities for the beneficiaries. So success of stewardship really much relies on a clear understanding of the different roles at play in this web of sustainability, of the sustainability ecosystem. And what we've tried to do in the code is also to really make sure that there is, in the case, for instance, where there is a delegation of stewardship activities, which is often the case, that there is also a clear understanding of each of the role of the different actors here. So I just wanted to mention this point before moving to the content of the code, which is basically the next slide. So the code comprises of 9 stewardship principles. It really describes, and for each principle, there's obviously a guidance on the key elements for an effective and a successful implementation. So as we mentioned, the key principle of the code focuses on the two main means. So you see here voting and engagement. So principle 3 and 4, that are the two critical means by which stewardship is commonly achieved. But it also obviously goes on a lot of other principles that are also very critical, from the governance aspects all the way to transparency and reporting. I also wanted to mention the importance here of escalation and basically what happens, how an escalation can be triggered, what happens when an engagement fails, how is that escalated, and as Clara mentioned, this is actually, escalation efforts are actually a strong component of stewardship. What is also maybe very different from, for instance, the UK code, I mean, where we probably go a bit beyond what's in the UK stewardship code, is there are a few recommendations on delegation of stewardship activities, and we believe that it was really critical to have some guidance there, as a lot of asset managers or investors are also relying very much on delegation and do not do those efforts in-house. So in a nutshell, that's the 9 principle. Obviously, I'll be very happy to answer any question. The code, as I said, is available on our website and through the QR code that you had. Obviously, I encourage you to apply the code and to apply it to all asset classes. As I mentioned in introduction, the code remains very general and can be implemented and interpreted for each asset classes, including alternative investment. That is really the topic of today, and I believe we'll have more color to that in the context of the case studies that we'll have in the second part of this webinar. Thank you very much, and I hand over to Ula for an asset owner's perspective, and Ula is also one of the key contributors of the code, so she's very familiar with the Swiss Stewardship code. Thank you, Ula.
Hello, everybody from my side. I hope you can hear and see me. Thank you very much, Aurelia, for the introduction. And thank you also very much for the invitation. Happy to be here today and talk about the Nest approach to stewardship in alternative investments. So let's get started on the next slide. Thank you. You see what I prepared for the next 10 minutes. So I'll start with a short overview about Nest, who we are, and then I focus on the sustainability approach we have and what are the differences in public and private markets. And today we're going to focus on the private markets approach. And I'll conclude with a few key findings in our experience, what we found out so far while we've been implementing this approach for a few years now. So on the next slide, some facts and figures about Nest. We were founded 40 years ago as the ecological ethical pension fund in Switzerland. And being a collective foundation, our situation is a bit different from others. We're, so to say, on the market compared to public pension funds or company-owned pension funds. So the companies that join us, they know about our sustainability focus. And with almost 4 billion Swiss francs assets under management as of today, one could say that we're a medium-sized or a larger of the smaller pension funds in Switzerland. So on the next slide, you see a short overview about our strategic asset allocation, which is pretty typical for a Swiss pension fund. Large allocation to listed equity and bonds, of course, and which is also typical for Swiss pension funds is larger allocation to direct real estate in Switzerland. And that's also the case for us. We don't do internal asset management, so we work with external asset managers, except for real estate in Switzerland. And as you can see, our exposure to alternatives is we have an allocation to private equity and infrastructure. We group them together since it's equity infrastructure, and ILS and private debt. For sustainability considerations, we don't hold let's say hedge funds and so on. And our allocation is rather large to alternatives, given that we're let's say a younger pension fund, so we can take the illiquidity exposure, but by law, the BFV 2, there are of course rules and limits to the allocation. So this is usually around 15% of the overall assets. So on the next slide, just to give you an overview, as I said, Nest committed to a strong sustainability profile already at our founding. So it's an integral part of our overall investment beliefs. Here you see some excerpts from our website. We have a dedicated sustainability concept, and it's an integral part of our investment guidelines as well. And on the next slide, you see an overview chart of the sustainability approaches we use. They differ from among the different asset classes, depends on the possibilities in the asset classes. As you can see, we grouped it, we committed in our sustainability approach that we follow 2 approaches: first, selection, and then, while we are invested, active ownership. And today, maybe the difference, we're going to talk about active ownership, which is used as a synonym for stewardship. Obviously, on listed equity, we vote. And that's through a service provider, TED Rating for Swiss equities, and now also for global equities. And we engage, and given our size, we're too small to engage directly with companies. So we're a member of engagement pools, very familiar, known in Switzerland, the Ethos engagement pool. There we're part of the international pool, and for Swiss equities of RSG, Responsible Shareholders Group. And now I'm going to talk more about what we do in active ownership on the private market side, and that's namely we engage. And because we work with external asset managers, so the engagement is different in the sense that we engage with our managers and not directly with the companies. On the next slide. So quickly to give you a short background, our sustainability analysis consists of 4 pillars. So we always look at these 4 core elements in all asset classes while defining what's a sustainable investment opportunity from our perspective. So firstly, exclusion criteria, they're fixed, written down in our investment guidelines. Then we look at CSR indicators. So how is a company doing something? But for us, that's not enough. So we also look at the products and services, what the companies are doing. So the impact of the business activities on society and environment along the complete value chain. And also important are the sustainability controversies that's there integrated in our approach. And obviously in public markets, we have a company rating that consists of all these parts. And because of lack of data in private markets, as we all know, on that level, because it's private markets, we had to adopt our approach. And on the next slide, I quickly walk you through this. Although this is the selection approach and not yet the engagement side, I still wanted to mention this because for us as an investor, stewardship already starts here. So we look for managers and we ask the managers who can work with to work together with them, who select funds for us with the industry subsector lists. And that basically covers the core elements 1 and 3. So the exclusion criteria and the products. So we have a list with green and red subsectors that are, sustainable enough from our perspective or not, and those are excluded then. And then as the second step, we ask our asset managers to fill in the sustainability questionnaire. It's a checklist. Basically, we ask them to use this during their due diligence with the investment funds. So on the next slide, you can, here's just a small example. You can just go further of the subsectors to give you an overview, which are red, green subsectors and neutral ones, which are also investable from our perspective. Yes, and on the next slide, we even think that, as also mentioned before, engagement is very effective or should be more important in private markets, since the holding period from an investor perspective is much, much longer, and also taking up a responsibility that we know where we are invested in. So we do a ESG or a sustainability controversy screening of all underlying companies once per year. And if there some controversies occur, if there are cases, and then we engage with the managers. And yeah, of course, we're just a small investor, small LP, and the value chain is long. So until it gets to the company through the lead investor and the main GPs and so on. But still, this is what we do. And really in extreme cases, we would divest. So we ask the managers for a statement. Is the case known? Is the company aware? And what happens? What were the measures taken, and so on. Although we know that divestment is very challenging and could be costly. And yeah, on the next slide is my final slide. Some key findings so far. in our experience, from our experience in the past few years, larger and sustainability-oriented asset managers already integrate the questionnaires systematically in their due diligence processes, which is very good. And it is possible, even as a smaller investor as we are, to include exclusion criteria in the side letters. And the reactions of the managers to engagement tend to reflect their sustainability approach. So if they're themselves already also very focused on sustainability, then it's the answers are, they take it more serious, let's say it that way. And it's really worth the efforts. And it's also about why we do this. It's about transparency and awareness raising and reputation at the end. But of course, we're fully aware what our influence can be or not, and it's unclear. So if it's direct or indirect investments, and LP versus GP. Yes, and at the end, so what we found out so far, that mainly sustainability-related activities in private equity, for example, including engagement, tend to focus on ESG risks and value creation. Yes, and on the next slide, just to end, thank you for your attention.
Good morning, everyone. Joanna Castro from Unigestion. So thank you very much Amas for the kind invitation. So I'm a partner at Unigestion. I'm focusing on our climate impact strategy and Article 9 strategy, and also our ESG integration across the portfolio. I'm based in Geneva. And in the next 10 minutes, I will try to give you an overview on how we implement stewardship in our Article 9 private equity fund. So just before we deep dive into the topic, just very quickly, for those that don't know Unigestion well, we are an independent and privately owned private equity firm today, being a great part of our overall Unigestion AUM with 11 billion. We have a global footprint across Europe, US, and Asia Pacific. We have over 30 years experience in private equity, and today we have over 70 professionals that focus across our primary funds activity, secondary co-investments, and including also our climate impact program. We have a wide range of products, and within that we have a differentiated approach when it comes to ESG and impact. And as you can see on this slide, all our programs focus really on ESG integration that really look into minimum safeguards, but also really targeting improvement of ESG characteristics. Then we have our direct funds that have a clear positive impact and look to find companies that have economic activities that promote environmental and social characteristics. So the typical definition of Article 8 funds under the SFDR. And then lastly, the fund I will talk to you about today is focusing on sustainability. It's a climate-focused fund and really targets companies that not only have a positive impact on climate, but also have no negative externalities and also good governance in light of the SFDR definition. Then focusing on the key topic of today, as I was preparing for this webinar, I thought I would try to summarize the 9 principles in a very easy way on how we apply that in private equity. So really looking at the ones that are already implemented in private equity, it would come as no surprise to you that governance is really something that it's at the core of any private equity approach, is really one of the reasons why companies are acquired within a private equity context. And so this is something that it doesn't really come as news for private equity investors. Then looking at voting, once again, we can benefit from a significant influence that we exert into companies, but also the close access that we have to management teams. Very different than what happens on listed equities, but as a private equity investor, you tend to be really at boards. If you are invested into funds in private equity, you typically have a representation of an advisory board, and it's really kind of typical for us to be able to vote on several topics that can go from financial topics to ESG or team, for example, changes. Then Monitoring of investees is also at the core of the success of private equity. We are paranoid about numbers, tracking data, pre-investment, post-investment, annual evolution. We are getting more sophisticated on even using artificial intelligence around data and analytics. So now we have to expand it further to non-financial metrics, but at least the DNA is there. Then lastly, worth mentioning about conflict of interest. As you probably also see, there's a lot of topics that can arise or emerge into conflict of interest in private equity. So most of the legal documentation of companies and private equity funds are already prepared to deal with conflict of interest. So this is really something that now needs to be extended for other topics, but in essence, the industry is already prepared to tackle that. When it comes to new features, I have highlighted three main topics that in my view and Unigestion views are still basically easy to implement. So if we start with stewardship policies, it's again related with governance. Private equity is very used to improve policies, processes, and really coming to improve the ecosystem that the company has in terms of governance. So expanding that to stewardship shouldn't be a problem as long as the private equity teams really have the expertise in-house. Then moving to engagement, once again, we are close to the businesses. We have been keeping dialogue about financial metrics and operational improvements. We should extend that to ESG topics. But the main difference here now is that we have to be a bit more collaborative. So the engagement is not so only individual, but we have really to be part of an industry pushing for more public engagements and also collaborative initiatives like the ones that Clara was mentioning earlier about, for example, the EDCI, the ESG Data Conversion Project, just as an example. And then lastly, the delegation of stewardship is also easy for us, given that we have been getting support anyway on the companies, because the private equity firm may tell you they do everything, but they use a lot of external support. They use operating partners, they use a specialized kind of support on, for example, pricing policies, marketing, operational changes. So it's really already a common relationship to have. And so now, once again, we would have to extend it towards stewardship topics. Then finally, the two key challenges I wanted to highlight is really about escalation that you already heard today from Clara, that it's a key topic. And in private equity is really challenging given the whole long holding period that you have and the ability that you cannot just trade off a stock today if you are not happy and tomorrow is out of your portfolio. It's really about having a very clear process, and I will come to that in a second on how we do it at Unigestion. Lastly, transparency and reporting is obviously key. Private markets, as you know, are more opaque. There's less transparency on the information. There's a huge lack of resources. I think you already heard today also from people like Clara that mentioned that the industry is struggling, and so is private equity. So it's really important to ensure that you can convince the private equity companies to provide us the data, but also get accurate data, benchmark it properly, and really be able to define priorities and the progress. And this is really an industry challenge that we are currently embracing as much as we can. Then very briefly on our Article 9 fund, so we focus on climate really with the angle of investing in companies that decarbonize the economy. And we have been investing now in this program for the last 12 months. And here is basically the focus, as you can see, very similar to the approach that Ula was saying. We have very specific sectors that we target that will allow us really to achieve the significant climate impact at the same time as attractive returns when it comes to this strategy. And so how do we implement basically the stewardship? Actually is really linked with the strict process that we have in an Article 9 fund. So stewardship has really to start pre-investment. Asset managers, investors really have to do it before investing. Otherwise, if you don't have a clear plan, if you don't have a clear timeline, target outcomes, and even as detailed as quantitative KPIs, it will be much harder for you to be successful on your engagement. So for us, it's really about starting earlier when we're doing due diligence on the assets and knowing beforehand what we're going to find post-investment. Then post-investment, it's about executing on the strategy or on the plan that you have defined during your investment. So it's really to focus on the timelines, on the same KPIs that you have defined, and really being able to assess progress. Having like points of, as we call it, check-in points, to see how you are progressing on your engagement is critical in our view for its success. And if you have inadequate KPIs, you are much more likely to fail on your target, to achieve your target outcome. So overall, the last message is you need a lot of resources and time to deliver on these engagements. And as I mentioned, technology could start helping you. There's data collection platforms, but the stewardship last mile, the part that really will get you to the target outcome, will also require a lot of human input. And that is a challenge that the entire industry faces today and will continue to face in our view. So concretely, what are the challenges and what are the key strengths? Let's start with the positive side. So implementing stewardship will allow us further to deliver on this dual objective of an Article 9 strategy, which is attractive returns like any other private equity firm, and also quantify climate impact. And maybe in our view, we actually look at this to be an enhancer of value. So as long as you have a value enhancer, you really will be able to generate attractive returns. Then in private equity, you typically benefit from nimble and innovative business models. And these businesses are well prepared for change. So they will be way more keen to drive their engagements because at least they won't take change as something that they block or there will be an immediate barrier as an entity. Then, as mentioned, long-term activist approach is something that we really see as a positive towards value creation. We also see that stewardship can also bring downside resilience to material risks, so we're really avoiding losing and having financial deterioration. And lastly, really the governance being at the core of the value creation of private equity. The challenges, I already alluded to some of them, but just to summarize, really consistency of the application of escalation policy is critical, and really being aware of the process that is needed around conflict of interest. You may face a situation where you have your fiduciary duty as a manager facing basically a difficult decision to exit a company or not. So you really need to have a process in place that can be addressed and cannot be questioned at the time of taking these important decisions. The second point is about having accurate and quantified reporting. So this is key for you to ensure that you achieve your target outcomes of your engagement. And lastly, the adequate level of transparency and quantified reporting, and for us, we stress the word of quantification, so very credible and objective KPIs to demonstrate real progress. You really want to understand how your engagement is going forward. And for example, in our climate fund, we don't make any investments if we don't have quantified KPIs significantly time before we invest in the company. So these are areas for you to be aware of. And when it comes to how to address them, our view will be summarized in 3 topics: to have very straight and strict processes that create no ambiguity for anyone that implements them. The second topic is really have adequate level of resources with all the challenges that we heard about, the lack of qualified people to deliver on it. And lastly, use technology, use tools, use frameworks that are available increasingly more in the market to support this already challenging task. So with that, this concludes my session. Thank you very much for listening, and we hope you find it informative. So I'll hand over to Anna. Thank you.
Thank you very much, Joanna. Happy to continue, and now shifting focus a bit more to the hedge fund space. So I have divided this into 3 parts. I will share some short background on LG Capital Partners, as that's quite important to understand the engagement work that we do. A bit on how we work with our hedge fund managers, as both Joanna and some other speakers said. Of course, it's very important how we select the manager, because that's done also to some extent define the engagement work that we do. And then at the end, share some real case studies on how we have worked with our hedge fund managers. So maybe if we can go to the first slide showing, let me see what number it is. Slide number 4. Yeah, perfect. Thank you very much. So some background on LGT Capital Partners. So we were founded about 25 years ago and started more or less as a family office for the princely family of Liechtenstein. And early on, we took the decision to invest in a diverse portfolio, and we also took inspiration from endowment funds like Harvard and Yale. And this meant quite a strong focus on alternatives, as you can see here, and that's still the case today. Today, we're a global asset manager. We have close to 100 billion assets under management, dollars or Swiss francs. But what's important is that still today, we act as a principal investor out of this endowment fund. So within this endowment fund, we partly invest directly into companies where we have the in-house expertise, but a large part is also still allocated to external managers. And that's going to be the focus here. So if you look at the hedge fund part, we still have quite a high allocation to hedge funds with 70%. This has we have then broken down into systematic and discretionary strategies, as there are quite some differences. And also, if you think about ESG and especially engagement, the two buckets are quite different. So, for example, within the discretionary bucket, we have the long-short strategies, merger arbitrage, more sector-focused strategies, and also some regional specialists. Whereas in the systematic bucket, you find the quantitative strategies, the trend followers, AI, machine learning, where many of these latter ones, they trade more derivatives and don't hold direct shares. Overall, for this whole endowment fund, and that also then is true for the hedge fund part, is that we have set minimum ESG target scores that then breaks down to the individual managers. And we also work with net zero aligned carbon budgets for the different asset classes. Also important to note is that for most of our hedge fund investments, we invest with our so-called managed account structure. That makes a difference because we then have full transparency. It's traded in our name and we can see all the holdings in the portfolio. So moving to the next slide and looking into how we ensure certain ESG standards and also how we identify areas for engagement. So similar to what you heard before, also for our hedge fund managers, we definitely evaluate the managers before we invest. It's always much better to do a very diligent work before you invest. As we heard, evaluation processes are quite tricky. And we want to be aligned with managers already at the time of investment. So we use an ESG questionnaire. And in addition, since we have this managed account platform, we also do a bottom-up screening. Here we have our own in-house analytical tool called the ESG cockpit. And we can then see that from the questionnaires that we ask the managers, that is also reflected in the actual portfolio. And this assessment is then included in the AIC book and part of the investment decision. And then secondly, on the right side of this chart, once we are invested, we do an annual review of the manager, again using an ESG questionnaire, and we also screen the portfolio here to see what's actually in there. And for these questionnaires, we also usually try to have specific topics. So, for example, in the last years, we had special focus on diversity, equity, and inclusion, on climate action, and so on. And if we then move to the next slide, coming more to the engagement part and how we can work with our managers. On the left side, again, you see the topics that we already discussed, how we select and monitor our hedge fund managers with an ESG and climate lens. From these discussions, we can then identify certain topics for engagement. And with the managers, the engagement can be either on the overall strategy, as you will see in the case studies that we're bringing, or more on specific companies. we're very big believers in sharing of best practices, and given that we work with quite a few hedge fund managers across the world, we know it's a very competitive world, and by hearing about what others do well, it can have a very nice ripple effect, and we definitely see other managers catching up by hearing other examples of what's working well. And what we also do in addition is that we share some data with our managers. So for example, on the climate side, we work with a so-called budgeting approach for net zero alignment. And here we can then also share this data with the managers and have a dialogue around certain companies in the portfolio, and especially focusing on the ones that are furthest from being aligned. Here we try to ask them if there are reasons that they see for staying invested, or if there might be reasons for actually divesting from the firms. Then moving into some real examples, I thought it could be good to share a few positive examples of things that we have been able to achieve together with our managers. With this example of a quantitative equity market neutral fund. So they trade a very big universe. They have more than 10,000 stocks in that universe. This was a manager that we had worked with for many years, and they kept delivering very good financial results. They did adhere to our minimum standards, but we felt that they did not quite live up to the increased ESG standards that we are looking for within hedge funds, both when it comes to ESG scores and also being net zero aligned. The manager here was very open to have that dialogue and trying to see if there were other ways of, or if there were ways of implementing ESG. And in this specific case, we were actually not invested via managed accounts, but we were invested in the fund. When we have managed accounts, it's always a lot easier to implement our ESG and climate standards because we are the only investor. Whereas in funds, obviously, we're together with a lot of other investors in there, and there has to be, investors taken into consideration. But here, together with the manager, we defined a goal of integrating ESG into the process, and could take into consideration mainly our ESG and climate standards. And here we work together with MSCI as well to build a new ESG defensive equity benchmark, taking these parameters into consideration. Once this was done, we had a new defined investment universe that then lived up to these criteria. And in 2019, we were then happy to see this new strategy, or it was actually an asset class as part of that main fund. And I think the positive thing here, even if we really like to have managed accounts, the positive thing here is that we can also do something positive for the wider investor universe. So it's not just something that we do for ourselves, but this share class was opened up for other investors as well. In the initial phase, to be honest, we didn't actually, or they didn't see a lot of interest for this additional share class, but especially during this last year, they see more and more investors actually showing interest for this additional share class. So this is for us one example of how we can work together with a manager to improve the profile of the fund, or in this specific case, the additional share class. If we move to the next slide, a second example, that's a more recent launch. Here we're looking at a long-short equity manager. And here we knew the team from before, and again, we're very convinced about their investment skills. At the launch of this new strategy, they had an ESG policy in place, but for us, this policy was more focused on CSR, so their own operations, and being a US manager, they also had a large focus on charity work. But for us, there was a bit of a lack of commitment into the investment side. Again, it was a manager that was very open for dialogue, and the positive thing here was that they could really see the value of adding another, especially risk filter for the portfolio with the ESG and climate considerations. So we discussed different ways of approaching it, again, showing different examples what we had seen. In the end, the manager decided to go with a well-known ESG data provider and could get a very large set of ESG data. And from that, they created a red light system to both monitor and also engage with companies. And what was interesting here was that when it was initiated, this new red light system, there were 3 companies in the portfolio that were red flagged, so not living up to the ESG standards. Here the manager decided to divest from one. This was an energy company, and they actually looked closer into it, where the manager or the company, they had some nice text around what they wanted to do on the climate side and transition plan. But when they actually looked at where they were investing and how they were working with those transition plans, they could see that it was very far from any net zero plans. And then they decided to divest from that company. Whereas to other red flag companies, when they looked closer into them and had a dialogue with them, they could see that they were actually improving on a lot of factors and decided to hold on to those 2 companies and more monitor the situation. And this is also very much aligned with our own philosophy, that you can get so much further by engaging with companies instead of just selling off from positions. But then on the other hand, when you see that there are no progression and philosophies are not aligned, you might sometimes have to divest. So coming into the next slide and the last one, this is showing more the engagement work that one of our managers is doing. And if we look at the hedge fund space overall, I think it's fair to say that they are lagging behind when it comes to engagement. So this is something that we really try to encourage. And I think this manager is, for us, one of the best practice examples that we have in the portfolio. It's a credit manager, and they actively engage with their underlying companies in a very structured way. So they really look at the issues that are in there. They have a dialogue, and they do very credible follow-ups and monitor the situation. So this is something that we do discuss with our managers and that we hope to see more of in the future. And with that, I'm rounding off and handing over to Peter, I think, for the panel discussion.
Exactly. So thank you, Hannah, for sharing your insights on the hedge fund side, so the engagement on that part. So now we're moving over to the round table. So welcome from my side. I'm happy to moderate this panel where we'll bring together experts from the stewardship side, looking at this issue from different perspectives. So as the speakers have already been introduced, I keep that one relatively short. So on the panel, we have Clara Melo from PRI, we have Ulla Enne from Nest, Joanna Castro from Unigestion, and we have Hannah Edström from LGT Capital Partners. So just to kick it off from my side, the first question, I would shed some light on the journey so far. So when you started engaging with managers, what has been their reaction, or what have been also certain barriers to really get started? So Hannah, what has been your experience?
Yeah, thanks, Peter. So yeah, we have engaged with both managers and companies for many years, and I think it's fair to say that in the beginning it was much harder than it is today, and many managers were quite skeptical. They saw it more as additional work, also limiting their investment universe, being worried that it would have a negative effect on the returns. I think very positive is that this has really changed. Most managers today are very open for engagement and even proactively reach out and ask for guidance. we still observe quite some differences if we look at alternative investments between private equity and hedge funds, where private equity managers are definitely further. And I think that there's still quite some work to do on the hedge fund manager side, but we also, as shared before, we see some good examples here as well on how to engage with managers and receive quite some positive results.
Thank you, Hannah. So what have been your impressions, Joanna?
So very similar with Anna's view. I think in the last 13 years of engaging with fund managers and companies, it has been a long journey, but it's definitely improving. And I think the frameworks that Clara mentioned at the beginning, that are coming up more and more, are helping there. But you still have quite different approaches according to the regions. In Europe, it's a completely different mindset than if you approach US managers and companies, or in Asia. So I would say the main complaints we still see, or pushbacks, remain around the impact on deal flow and the fact that that can change the risk profile of the companies and returns, the lack of resources and data. And then there's concerns around the time needed, but also what will be done with that data. How do you benchmark? What are the conclusions that you take as a result of that? So in our view, the way we tackle these challenges is really to push more for these initiatives, do the collaborative engagements that we need to make that really, to create a kind of a good reach, and because I think we will all benefit. And then we really focusing the managers and the management team of the companies on the value creation that these engagement will enable them to achieve. So this is the only way we found so far to be successful on the engagements.
Thank you for that. So I would like now take a bit of a closer look at the characteristics of alternative investments. So Ula, you mentioned in your presentation that ESG approaches are a bit different from the alternative to the traditional side. So looking specifically on the alternative side, do you see that engagement approach is different between the liquid and the private segments? And how do you address that in your process?
Yes, thank you, Peter, for the question. Yeah, for us on the liquid alternatives, we basically just have ILS, and here we have selected funds. So it's pretty basic what we do here. And what was mentioned before, basically, we ask the managers to ask those questions that were presented by Hannah and Joanna. And in private markets here, it's a bit different. That's the approach I described to you. And so here we have also the experience here in this area, it's much more going on.
Thank you, Ula. And how do you see that kind of difference on the liquid and on the private side, Hannah?
Yeah, sorry, I did not hear everything again. Seems to be some difficulties, but I think one thing that we observe, and what is very different for us when engaging on the liquid and private market side, is the insights we have into the portfolio. So as mentioned before, for the hedge fund portfolios, we can really do the bottom-up screening, and we can really look into the actual companies held in the portfolio. So we can have much more direct dialogue on certain companies that fall behind in terms of our ESG scoring or net zero alignment. On the private market side, and it has been mentioned a couple of times now, the data convergence initiative, and I think that's something that we are very positive about. So the way we use it, so we were part of the initiatives, and there are more than 300 GPs and LPs now as part of the initiative. And the way we used it now was to look at which of our GPs in the portfolio were part of this initiative, and we reached out in the first instance to all of them and asked them to report according to this new template. And now in the second instance, we're also asking the rest of our universe to report according to this standard setting. So hopefully with these initiatives, we will over time get more data. And again, I think once you see the first ones moving, we know that there can be quite a positive effect with more joining as well.
Thank you, Hannah. So now I would like to move a bit more kind of to the Swiss Stewardship Code and its kind of core principles. So looking at recent PRI surveys, it is clear that for an increasing number of asset owners, but also asset managers, outcome orientation has been defined as a priority when it comes to ESG integration. And a bit related to Principle 4 in the code, which focuses very much on engagement and reaching long-term sustainable outcomes. How do you measure change, especially after engagement with a certain manager? So, Jana, what kind of instruments you have at hand?
So on our side, it really starts by having really a plan that has to be very well defined in the outset. So this is key for us in terms of a successful engagement journey. We believe that investors need to have a clear timeline. They have to define clear checkpoints that can be on a quarterly basis, semi-annually, whatever suits them and the topic. And then you really have to have a very clear target engagement outcome. So you meet the expectations of where your journey should be heading. Then the most important topic for us around this principle is really the quantification and the fact that you really have to find the right adequate KPI for the target outcome that you have. It doesn't have to be several KPIs, maybe one or two, but the one that credibly measures the progress. So you can really assess over time and adjust if needed your actions, initiatives, the way you are tackling the engagement. And then really we find it as really, if you cannot measure properly, you can really define, in our view, that was a successful outcome. So that for us is really the core. And then we also recommend that post the engagement, depending, I think, on whether, let's assume that it was successful, then the investor should continue tracking that same KPI to ensure that you don't fall in the situation where you were a couple of years or months ago. So the continuity on that is quite important, but for us, the core word here is quantification and really adequate tracking of that target outcome.
Thank you, Joanna. And how do you measure change at Nest? Ula, what's your thinking?
Yes, thank you. I totally agree with what Joanna said here. And since we work with managers and they engage themselves and do the monitoring on progress, so our approach in engagement, how we measure it, it's like complementary. As I described, we screen for ESG issues per year on the underlying companies. So kind of as a double check, an additional layer here. But of course, I mean, measurement, that's totally qualitative here and it's case by case. Luckily, because our approach is what it is, we don't have so many cases or occurrences of bad controversies. And what we do is really case by case, depending on the company and the sector, we request a statement and the manager to go to the company or lead GP. And I mean, yeah, and if they're, how can they ensure that it won't happen again? And all those steps, different in the process. And yeah, I mean, it's also interesting to collaborate on this with the managers to find out if they also saw this case that happened or if they didn't, or what's their reaction. That's also kind of to better get to know the manager actually.
Thank you, Ula, for that. So now I would move a bit kind of to the broader picture and look at all the 9 principles. So, I mean, where do you see the benefits of that code and how can that be used in the daily work? Clara, what's your opinion on that?
Thank you, Peter. I think Aurelia's presentation has outlined very clearly the whole set of issues that stewardship codes can drive progress on. They're really crucial tools for setting an ambition and pointing to the main areas of expectation, creating a standard of sorts. For me in particular, a highlight that of an issue that's included within the Swiss stewardship codes, and I think that other stewardship codes should cover more precisely, is the issue of public policy engagement, because this is what will support also broader change beyond investees and accelerate the changes needed elsewhere. I think the fact that stewardship codes can play a role in highlighting the importance of investor engagement with non-issuers, with stakeholders such as policymakers, standard setters, and communities is really important to tackling system-level risk. And so this is very welcome from the perspective of stewardship codes.
Thank you for that. So I think, as we have heard here also in the presentations, engagement efforts work well in the majority of cases, but there are, of course, cases where requirements are not met by the managers. So related to Principle 4 of the code, my questions are going into that direction, that what kind of escalation process do you have in place, and how do you enforce your standards? Is potentially also divesting an option for you. So Ula, how do you see that?
Yes, divestment is an option for us, obviously, but really in the worst case, and luckily we never had to do that so far. So for me, it goes hand in hand. Your selection process, that you apply your sustainability criteria already before, that you have a clear plan and you look where you invest, but then also that's your expectations are clear. And then during the investment phase, you go hand in hand, work on this together and engage. So, but yeah, I mean, of course, we know like divesting could be costly, secondary sale, you have to take the discount and so on, but definitely we committed to that, to give it a bit of more, that it has to be credible. So that's what we always say, and that's the thing. But there are different options for escalation processes. I mean, another option is we just don't commit to the next fund of the manager. That's another option.
Thank you for that. So Joanna, what's your take on that, or what's your escalation process?
So yeah, so we also agree with Ula that you have to have a very clear process, and it's important that if you define the rules of the game pre-investment, you are less likely to get yourself into escalation situation, let's say. But obviously it can happen, and investors need to have a very clear guidance on that with a very clear process, because again, can be very tricky. So for us, it's quite progressive. So the first step would be you engage with the fund manager or the company management team and really discuss what's behind the issue and define a remediation plan with a clear timeline. Then you track that progress, and then the next step would be, if there's little to no progress, then we would move to the next level, which means that you will engage with the other shareholders or the other LPs in the fund to consider the removal of either the management team or the fund manager. So that we have done. It's very important that everyone understands that can take 2 years, that can take court discussions, that can take a lot of legal bills and senior resources being drawn into these. And I experienced myself that personally, unfortunately, 1 or 2 times already. And then the last resort is, if it's very difficult sometimes to align investors around the same common goals. When that is the case, then the last resort is the divestment that Ula already mentioned, and as a result, the fire sale or the discount to your current valuation. In that circumstance, we believe that investors in the company, or in our case, if it would be a fund of ours, should also have a say on that. So we retable the proposal and we say, okay, so this is the fiduciary duty, and we are kind of mentioning the topic, but this is also what we should do in accordance with our escalation. So collectively, we would take a decision. Obviously, depending on the severity of the issue, you may go straight away to the divestment situation, but in most of the cases that we had to go through escalation, the process should be gradual, and you should start with a discussion in the same way that you do if your EBITDA has dropped 20%. And then, if your CEO underperforms and your business plan completely went to the trash, then of course his job is also at risk. So we follow the same approach. So it's very clear for everyone what are the rules, and frankly, to be open and transparent about this since the beginning also is quite helpful in our experience.
Thank you for that, Joanna. So I think I also want to address kind of the topic around resources. So Clara, you mentioned in your update that you have the impression that stewardship functions are still quite largely under-resourced. What are the barriers or also potential solutions to get more power for these activities going forward?
Yes, absolutely. This is something that we're hearing from the industry, and therefore my team has started a project of studying stewardship resourcing among investors. And we see two kinds of barriers to adequate resourcing. The first ones are system-wide barriers, because there can be difficulty in articulating and justifying the value of stewardship costs. And for that, we see that asset owners can have a role in clarifying their stewardship sustainability-related expectations to managers. And regulators can clarify that an investor not only has a duty to consider undertaking stewardship to serve beneficiaries and clients' best interests, but also clarify to what extent investors may incur reasonable costs in doing so, because this can be a barrier for certain kinds of investors. And then there can also be an issue with capturing and accounting for the benefits and outcomes of stewardship, and this needs to be addressed by better practices around reporting. Then there are practical barriers. First of all, there's no agreed definition of what good stewardship resourcing looks like. There's no single metric to measure it, as many alternative investment specialists will know. Then you'll also have teams where the stewardship functions are spread across a lot of different staff. There's not necessarily a dedicated team. There can be deal teams taking care of that. So that means that the measurement of stewardship capacity and resources might be more adequate if expressed as a total aggregated FTE rather than a headcount, for example. There's difficulty also in capturing the variety of stewardship resources that are contributing to stewardship outcomes in not only a consistent way, but also within kind of a sort of itemized budget. This is something that our resourcing work hopes to tackle, and will be publishing a report with the Thinking Ahead Institute in the first quarter of 2024, where we'll cover findings about current practices, but also make recommendations about desirable resourcing levels.
Great, many thanks for that. So working for an asset manager, so how do you engage internally kind of about the value add of active stewardship? Hannah, what's your engagement internally?
Yeah, thanks. Yeah, so just short background is that we come from a very decentralized ESG structure, where it's been important for us that the investment teams themselves take responsibility for ESG integration, and that then also includes the engagement work. So we see ESG as very relevant for financial performance of these companies and managers, and therefore we think it's important that the investment teams are involved, as these dialogues can be very important information sources. So for this reason, we never had a large engagement team on the side, but it's really been growing with the teams on the investment side. However, at the same time, we obviously realize that the topics and also the depth of engagements are really getting deeper, and the topic.
From my side, I think Anna got lost, unfortunately.
Yeah. For some reason, can you hear me again?
Yeah, maybe we can switch to the last question, or was it the last question, Peter?
We are approaching the end, so I have one final question. So kind of, I would like to look a bit more also now into the future. So what are your expectations going forwards? Where do you still see gaps which need to be closed? So Ulla, what are your key points?
Yes, so basically what we expect or we'd like to have is, as in the past, that our exclusion criteria can be implemented inside letters, that we receive ESG reportings and monitoring reportings on the progress depending on the investment phase. So not just because here it's pretty much already evolved a lot, like at the beginning, but also to receive consolidated reports from the manager, ideally from our perspective, that we can also compare the progress of different funds and investments, but then and comparability over time, of course, because now and a few years back many have started, and it's going to be interesting to see how it evolves and on the different phases. And also very interested to hear then about ESG actual measures taken during the exit phase when it comes to ESG. And and given that we have the stewardship codes now, stewardship reporting, and how the principles are implemented. But as you all said, and it's been talked about, it's a question of resources and so on. So happy also to see the PRI stewardship resourcing piece. Thanks.
Thank you. So, and probably Clara, what's your view? If you can just outline your key point very briefly.
Thank you. I think the main call for action is going to be about managers considering their relationship as assets more if they don't already do so. So in terms of relationship with investees, it means also taking an active role in achieving board accountability. When it comes to relationship with asset owners, it's going to be reporting back in more detail on how they're working to achieve stewardship outcomes. So articulating strategy, stewardship and escalation practices, collaboration activities, but also policy engagement and being clear about what they're doing in terms of wider political engagement and lobby. Lastly, thinking about their relationship to stewardship itself, taking a hard look at the amount of resource they dedicate to stewardship and ask themselves whether their ambitions and that of their clients are being matched with these resourcing levels.
Thank you very much for that. So we are at the end of the panel. So I would like to take this opportunity to thank the whole panel for the engaged discussion. I think everyone on the panel, but hopefully also in the audience, could learn something and pick up a few takeaways. I think it's very important having these discussions and having that exchange. So with this, I will hand over to Rachel.
Yeah, thank you so much, Peter, for this great roundtable. But before finishing, I would like to introduce Adrian Schatzman, the CEO of the AMAS, Asset Management Association. And it would be quite interesting to know what will be his closing remarks and how he found this webinar. And I wanted also to thank him and the AMAS team for the great help and support that they have been providing to the AIC for a number of years now. So please, Adrian.
Thank you, Regis, and I keep myself short looking at the watch. But first thing first, let me thank all the speakers who contributed to what I thought was a very interesting, very insightful event today. What I learned to your question, Regis, was certainly there is no one approach for stewardship within alternative investments. It's not only company specific, but different asset classes, different investment styles require different stewardship approaches. If I briefly look ahead, what lies ahead, stewardship is crucial for our industry. Don't forget that still most of our assets are still traded at the secondary market. And while we talk about sustainability, what typically the policymakers, the public media, what they mean is that the financial industry should generate impact. And if you act mostly in the secondary market, there is limited scope. And this is why stewardship and in particular engagement is so important for us. Aurelia presented the Swiss Stewardship Code. I think that's a very important first step. It's a first step. It's paper. It's good paper, but it's still paper. And we at AMAS, what we want to achieve and what we want to contribute to is obviously to impact. We want to make a difference with our work. And this is why it can't stop with this code. Events like this, for example, are extremely important to roll out the stewardship code across the industry, across the ecosystem. But we're also actively thinking about an engagement platform for asset managers to join and add more weight to particular causes. So there's more to come on this one, and I'm pretty sure if we meet again 1 year down the road, we will update you on this topic. But now we still have a couple of busy days ahead of us once they're done, I wish you, your family, all the best for the festive season, to the Christmas days, and a Happy New Year. Thank you very much.